Welcome to vTalkInsight, Market Drivers Daily for January 23, 2026. Markets are waking up to a powerful mix of easing tariff fears, an AI capital spending surge, and remarkably strong growth signals from the United States and abroad. The key issue now is whether this combination marks the start of a more durable risk-on phase or simply a pause in an increasingly volatile geopolitical regime. Geopolitics remains the main macro overhang, even as markets enjoy a modest sense of relief. The withdrawal of imminent U.S. tariff threats on Europe and the shelving of more provocative ideas around Greenland have taken the edge off the worst-case transatlantic scenarios. Equity futures in both the U.S. and Europe have responded positively, and measures of European credit risk that spiked earlier in the week have already retraced. Yet that relief looks fragile rather than decisive. Recent days of confrontation over Greenland and tariffs, highlighted in earlier sessions this week, have eroded trust among Western allies. European leaders are now more openly pushing back against U.S. policy, and the European Parliament has frozen work on the trade deal while preparing retaliatory tools. At the same time, gold prices are holding firm and major banks have upgraded their targets, underscoring that investors still expect a persistent geopolitical risk premium. Beneath the day-to-day noise, the global security architecture is shifting in ways that may reshape capital flows over the coming decade. The war in Ukraine remains a grinding, high-cost conflict, with Russia making only incremental territorial gains despite severe casualties. NATO leaders stress that Ukraine's defense depends on continued supplies of interceptors and equipment, and they argue that today's support is also about deterring future aggression. This is feeding a structural rearmament cycle. Germany plans to lift defense spending by around 90 billion euros by 2029 compared with 2021. NATO members are preparing over $1 trillion of extra investment, and there is discussion of allies targeting as much as 5% of GDP for defense. In parallel, Arctic security has moved center stage, with coordinated efforts to limit Russian and Chinese influence and negotiations over a larger U.S. presence in Greenland. The controversial new oversight structures around Gaza, with contested membership and funding, add to the sense of institutional experimentation in a more multipolar world. Energy and natural resources sit at the intersection of these tensions. The United States is using financial leverage rather than troops to reopen Venezuela's oil sector, encouraging investment from firms such as Chevron, Repsol, and Eni, while stopping short of offering security guarantees. Policy aims to restore exports quickly and stabilize the region, but large-scale industry participation still looks contingent on clearer legal and political frameworks. At the same time, competition over Arctic oil, gas, and minerals is intensifying, and governments are prioritizing strategic stockpiles and domestic processing of critical materials. Europe is seeking to diversify away from Chinese rare earths, while France is pushing new supply chains for critical metals and export diversification for sectors exposed to U.S. tariffs. These moves, together with heightened demand for insurance against civil unrest and supply chain disruption, point to a world where geopolitical risk is increasingly priced into both commodities and corporate operating costs. For markets, the result is a complex mix of near-term calm and structural unease. Bond markets have already demonstrated their sensitivity, with recent global volatility driven by shifts in Japanese yields, questions around central bank independence, and geopolitical headlines. Despite the latest easing in tariff rhetoric, investors continue to add exposure to perceived havens such as gold and select commodities, and private market allocators are deliberately diversifying exposures by geography and strategy. The counterpoint is that many policymakers still frame U.S.-Europe frictions as temporary disputes, and there is active work on new frameworks for trade, minerals, and security. Long-term cooperation across the Atlantic is still described as essential by officials on both sides, and Europe is being presented as an increasingly investable region as it shifts from planning to concrete action on competitiveness and sovereignty. The next set of U.S. EU negotiations on tariffs and defense, progress on Ukraine security guarantees, and the implementation of the Gaza oversight arrangements will be key markers for risk premia. Against that backdrop, one of the main offsets to geopolitical risk remains the AI-driven investment boom, which is reshaping both growth and market leadership. Artificial intelligence has clearly moved from a narrow tech story to a macro growth engine. Forecasts point to over $1 trillion of AI infrastructure spending by major technology firms alone in the next 3 years, and some industry leaders talk about total global needs in the multi-trillion range as data center, chip, and power demand scale up. Current AI investment in the U.S. is put at roughly 1% of GDP, while below the 2 to 5% range some see as necessary for full transformation, suggesting a long runway for additional Capex. The build-out is already reshaping the real economy. Global data center investment is projected to grow from about $500 billion to $1.4 trillion over 5 years, with power availability now a bigger constraint than land or capital. Demand for high-end semiconductors, especially memory and advanced nodes, is significantly outpacing supply, leading to shortages and supporting elevated earnings expectations for key players. Each gigawatt of data center capacity is estimated to require large amounts of industrial metals, such as aluminum, while salaries in chip-related construction have reportedly jumped towards six-figure levels, hinting at localized wage pressure. This surge in spending is feeding powerful moves in equity markets. Semiconductor stocks and AI-themed exchange-traded funds have staged strong rebounds, helped by upbeat commentary from leading chip executives and renewed enthusiasm for AI infrastructure. Investor attention is not limited to public markets. OpenAI is reportedly seeking over $50 billion of new capital at an implied valuation in the high hundreds of billions, and discussions of a potential trillion-dollar listing are seen as a key sentiment test for large language model platforms. But the exuberance brings classic late-cycle risks. Venture capital flows into early-stage AI companies are intense, with some managers flagging a speculative frenzy and extremely elevated valuations. Large allocators, such as Ontario Teachers, are emphasizing selectivity and questioning whether all current leaders can justify their pricing over time. There is a clear risk that if revenue growth at headline names disappoints, private portfolios could face significant write-downs, echoing past episodes in electric vehicles and other hot themes. Even in credit, AI-related corporate issuance is expected to rise, and while demand is likely to stay strong if earnings deliver, investors are braced for some spread widening as supply builds. On the ground, AI adoption is transitioning from isolated pilots to becoming a core operating platform for many firms. Some enterprises are already reporting rapid paybacks, with specific projects delivering returns close to 3 times the initial investment in short order. Companies like Workday are aggressively reorienting their strategy toward AI, hiring senior talent, emphasizing the value of curated enterprise data as a moat, and exploring ways to monetize access to their data through third-party AI agents. AI is also spreading across sectors. Retailers such as Walmart are using it to drive incremental revenue and improve cost efficiency, while global pharmaceutical players like Sanofi are embedding AI into research, development, and governance to accelerate decision-making. Banks are deploying AI heavily in risk management and operations, yet so far have managed to adjust workforces largely through attrition rather than mass layoffs. At the same time, the technology is creating new vulnerabilities. Deepfake tools are now good enough to convincingly imitate executives, and there are real-world cases of attackers using synthetic voice to request sensitive information. Universities are using AI to streamline admissions, raising concerns about bias, and AI-driven cyber attacks are eroding traditional language and geography barriers. Policy and geopolitics are increasingly intertwined with AI's trajectory. Data center infrastructure is being treated as a strategic national asset, and countries are racing to secure sovereign AI capabilities through cloud infrastructure, regulatory positioning, and access to advanced chips. Export controls on state-of-the-art processors, such as the latest data center accelerators, create difficult choices. Selling into large foreign markets can reinforce the dominance of U.S. technology stacks, but also risks enabling rivals to build on that foundation. Looking ahead, several themes stand out. Analysts expect much clearer differentiation within a year between AI companies that deliver tangible business outcomes and those that mainly market potential. The rise of stablecoins and digital assets, which global payment networks and banks are starting to integrate, points to a future where AI systems transact in tokenized money rather than cash. Personal AI agents could become as essential as email in the job market, increasing demand for consumer-grade GPUs in the home. At the same time, gaps in data ownership and identity frameworks, and the proliferation of AI-generated content that is hard to distinguish from human work, raise complex questions about authenticity and regulation. All of this feeds back into the broader growth narrative, where AI-linked productivity gains are now a central pillar. The growth backdrop remains strikingly strong, with the United States still at the center. Third quarter GDP has been revised up to 4.4%, and some officials describe current conditions as consistent with growth above 5% annualized alongside subdued inflation. Short-term data point to consumer price gains around 1.2% over the past 3 months, suggesting a rare combination of robust activity and contained price pressure. Forward-looking projections have been upgraded as well. Major institutions now see U.S. growth in 2026 closer to 2.5 to 2.8%, supported by fiscal stimulus, deregulatory moves, and the AI investment wave. Personal consumption has been running near mid-single digits year-on-year, with Bank of America reporting about 5% spending growth across its large customer base and signs of acceleration into January. Wage growth around 3 to 4%, combined with evidence that real wages have risen even in the face of tariffs, is underpinning household purchasing power. Small caps have outperformed large caps for multiple sessions, and transports sit only a few percent below their prior highs, reinforcing the message from more traditional macro indicators. Corporate earnings broadly corroborate this upbeat picture. Expectations are for profits to stay firm, with a bias toward low double-digit growth helped by strong nominal GDP. Surveys of business activity have climbed to their highest levels since early 2024, and some management teams are guiding to mid-teens growth in both earnings and cash flow for 2025, particularly in commercial and services lines. Micro signals from consumer-facing sectors are consistent with resilient demand. Holiday retail sales grew in the mid-single-digit range, powered by apparel for events and experiences rather than just basics, and luxury names such as Burberry have reported encouraging results. Investors are watching upcoming earnings from groups like LVMH as a bellwether for higher-end spending. Physical stores still account for the majority of sales, but e-commerce continues to gain share, prompting brands to reinvest in flagship locations and more experiential formats. There is also strong demand for retail space and for local service platforms, with companies like Uber reporting low 20s growth in transactions and healthy global spending on travel, dining, and commuting. Outside the U.S., several regions are showing more convincing momentum than in recent years. In Europe, policymakers are combining higher defense, spending, and industrial policy with efforts to improve competitiveness, and there is a view among some investors that the bloc is shifting from planning to execution on growth and sovereignty. Germany's planned increase in defense outlays, the European investment bank's growing focus on security, cybersecurity, and advanced technologies, and progress on trade agreements with partners such as India, Mexico, and Indonesia all support this narrative. Specific country stories add nuance. Spain is often cited as a strong user of EU recovery funds, with reforms driving productivity and digitalization. South Africa's medium-term budget and better coordination between fiscal and monetary policy have stabilized macro conditions, with growth expected to edge toward 2% by 2028 following improvements in the power sector and removal from a financial watch list. In Latin America, Argentina's low trade integration highlights potential upside from further opening, while a renewed U.S. emphasis on Europe's growth and on lower global energy prices points to a feedback loop where cheaper energy supports broader industrial demand worldwide. Still, the expansion faces several vulnerabilities. Growth is uneven, heavily reliant on AI-driven Capex and higher-income consumers, and exposed to renewed trade frictions. Rising tensions with key partners such as Canada and parts of Europe under the USMCA framework, unresolved tariff disputes with South Africa, and ongoing disagreements over digital regulation all inject uncertainty into cross-border commerce. A noticeable decline in international visitors to the U.S., attributed to weaker perceptions of U.S. culture, underlines how politics can spill over into tourism and services. Financial markets are also contending with episodes of stress. Recent bouts of global bond volatility, including sharp moves in Japan and the UK, have reminded investors of underlying fragilities around fiscal deficits, central bank credibility, and liquidity. Historical shifts from gold-based systems to fiat and rising debt burdens are being cited by some as a reason to watch today's monetary regime closely, particularly if geopolitical tensions worsen. European credit spreads have already demonstrated how quickly risk premia can widen and then retrace as headlines evolve. Labor availability is re-emerging as a constraint for small businesses, and youth unemployment around 12% in some segments highlights that not all parts of the workforce are sharing equally in the AI-enabled productivity gains. Looking ahead, investors are focused on whether this high-growth, low-inflation pattern can persist without forcing a hawkish pivot from central banks. Upcoming releases, including Manufacturing and Services Purchasing Managers Indices and the Conference Board's Leading Index, will offer early signals on whether momentum is broadening or cooling. Earnings reports from luxury, travel, and small-cap industrial names will help validate the idea that growth is rotating beyond mega-cap AI beneficiaries. At the macro level, the interaction between AI-led productivity, fiscal policy, and geopolitics remains crucial. Some forecasts now contemplate U.S. productivity growth in the 4 to 6% range, and real GDP growth potentially moving well above its historical trend later in the decade if disruptive technologies deliver. Whether that upside is realized and how it is shared across sectors and regions will go a long way to determining asset class performance. This sets the stage for a market environment defined by strong top-line growth but elevated dispersion, where scenario analysis and risk management are likely to matter as much as the headline numbers. The picture coming into focus is a world where geopolitical tension keeps a floor under risk premia, while AI-driven investment and unusually strong growth data continue to pull capital into equities, credit, and real assets. Tariff relief and new security frameworks offer temporary calm, but structural shifts in defense, energy, and technology suggest a more volatile regime, with greater dispersion between winners and laggards across regions and sectors. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.